the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view. But I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin. Currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that
Alden analyzes Bitcoin using a number of important frameworks, one of which is its connection to worldwide liquidity patterns. The price fluctuations of Bitcoin have historically reflected the rise and fall of liquidity cycles. Alden notes that liquidity is currently in a flattish phase, which is causing Bitcoin to enter a period of consolidation as opposed to a dramatic rise or decline. She notes that the price of Bitcoin, which is centered around $100,000 and swings a little bit above and below this threshold, reflects this liquidity environment. According to Alden, Bitcoin may see volatility if liquidity drastically declines. However, an increase in liquidity can push Bitcoin to all-time highs. Recent macroeconomic developments, such as adjustments to monetary policy and geopolitical variables impacting the dollar and risk assets, make this research particularly relevant. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
Right now, liquidity is kind of flattish. Bitcoin's been chopping along at 100K, above and below, kind of in a consolidation, and so that's making sense to me. I also look at Bitcoin through the lens of regulatory clarity. So there's a lot of companies that wouldn't touch it, but then once it got a spot ETF, and once you have a Trump administration election, they shifted their views on the acceptability of the asset from a tail risk perspective. And then in addition, I look at on-chain indicators. So mainly what I look for is not to use them as trading per se, but to look for major risks. So in years like 2021, 2017, and certain other years, there were on-chain metrics that showed a high degree of euphoria. So my favorite is market value compared to on-chain cost basis. And when that ratio gets really high, there's a risk of a multi-year correction. And currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view. But I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin. So that would depend, I think, significantly on how much they end up buying. And so, the U.S. has gold. It's not audited, but they have it supposedly. Merely not selling it has an impact on the price. If they were to buy more, that'd be bullish for the price. Bitcoin's a smaller asset, so one government can move the asset price more. Like this past year, MicroStrategy has been a pretty big driver of Bitcoin by being such a large purchaser. For example, if you were to see Uncle Sam become a big purchaser, like something along like the Lummis bill, for example, that would be massive for price. Whereas if they merely say, hey, we have existing Bitcoin from various seizures, and that with the exception of maybe some seizures that we're going to give back to the rightful owners, we're going to ring fence the assets we already have.
Just sort of eminent domain. They're ours now. Yeah.
Yeah, they're ours now, and we're going to call this. We're not going to sell it back to the market. We're going to actually just going to keep this for strategic purposes, and maybe we're not going to add a lot to it. That I think would generally not have a lot of impact on price because it's already kind of priced in. It's already part of that. So I think it would take a fairly large announcement of purchasing these types of assets to really move the price, versus just the optical thing of, hey, the U.S. is officially going to continue holding Bitcoin rather than selling.
Even if the U.S. didn't enter as a net buyer, could it force or inspire other countries to become net buyers?
I do think so, and we've generally seen this in the corporate space, which is that MicroStrategy kind of paved the way. We saw fairly small follow through with that from other corporations in the cycle that they did it. So in the whole kind of past 4 year period, we didn't see a lot of other corporations hop on board, or if they did it in a fairly small way. Whereas now, because there's been accounting changes, and because they see the positive example of MicroStrategy get through a full cycle and come out strong, there has been now a more recent flurry of corporations putting it on their balance sheet. Generally, most entities tend to be followers. There's a lot of career risk in being first and wrong rather
Yeah.
than following something with a clear precedent. And countries are very similar. So if they see both positive examples on the small scale, so the El Salvadors or the Kingdom of Bhutan, right? These are entities that have had very good fortunes with, having a long-term goal of, stacking Bitcoin on the sovereign level, um, and getting benefits from that and getting benefits from tourism around that, that can appeal to other nations. And then in addition, if the U.S. Is officially kind of saying, hey, we're maybe not going to buy a ton, but we're just officially going to hold Bitcoin. We think Bitcoin's a valuable thing to have a stockpile in, and so we're going to keep what we have. That does legitimize it in the view of many other sovereign wealth fund holders or reserve asset managers. So I do think it could be less career risk for larger and larger pools of capital to say, hey, we think having a non-zero Bitcoin position is prudent. Debasement is likely going to continue, and a lot of it is fiscally driven. Now, that does have implications for assets, so that's generally why I like to be, I err toward equities over bonds, and I err toward Bitcoin over many other assets. So it has implications for those fairly scarce types of assets. But the phrase itself is not directly about those assets. It's at least the way I use it. It's about the deficits themselves.
According to Lynn Alden, although macroeconomic conditions have remained mostly unchanged since the early 2023 regional financial crisis, they are beginning to change. The market is experiencing volatility again as a result of fresh policy changes, widening fiscal deficits, and currency value movements. The U.S. Treasury strategy for controlling liquidity during the last 2 years is one important element that Alden emphasizes. More short-term debt, such as T-bills, has been issued by the Treasury to offset the Federal Reserve's tightening, which has essentially increased system liquidity. Even as the Fed reduced its monetary support, this tactic has assisted in maintaining asset prices' stability. However, Alden warns that future liquidity conditions are uncertain, with potential changes in both Treasury policy and the Fed's actions that could have a significant impact on Bitcoin and other assets. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
So when we did a liquidity analysis on different assets, gold was somewhat mixed in terms of how much it correlates with liquidity, and a big component of liquidity is that dollar strength. And that's because when there's good liquidity, generally, and that often includes a weaker dollar, generally speaking, investors flock to risk assets. So equities, Bitcoin, that type of thing. Whereas when there's reason to be concerned, either because liquidity is bad or for other reasons, investors generally flock to, bonds and gold. And so gold's kind of got this mixed bag where on the one hand, it does benefit from debasement and a weaker dollar. On the other hand, it does also benefit from people coming to defensiveness while the dollar's strong and liquidity is not great. So I do think that can give you a second leg. I think it partially come to how well are big U.S. stocks doing, right? Because if investors say, well, if we're weakening the dollar and Bitcoin's going vertical and equities are going vertical again, then maybe I just want to be in there rather than gold. Whereas if you have more of that stagflationary environment where maybe, tariffs put prices up, and so maybe you get slowing growth, then you get squeezing margins, and then you get a weaker dollar. That could be an environment where, say, gold outperforms equities. So I would generally need more information to know what to expect in that environment. But I do think that's one of the potential tailwinds for, breaching above 3,000 or otherwise getting higher than we currently are.
What's your current assessment of the global economy and financial markets?
I think I would sum it up with volatility is back. I kind of viewed macro as somewhat boring over the past 2 years or so. I think ever since we had the regional bank crisis in early 2023, and that fire was put out, we've been in a fairly linear stretch of macro. Doesn't mean that there's nothing that's happening, but that things have generally been on roughly autopilot for about 2 years. And with the new administration and kind of the rapid flurry of kind of executive orders and other presidential actions, we're back in a period of uncertainty, higher volatility between currency pairs, and then of course that has implications for asset prices. So I think the main thing is that uncertainty is dialed up. Things can change. Like you could have a much bigger position change in, say, a given month in this new environment than it would make sense to have over the past year or two, where trends generally just kept going in a certain direction. Yeah, in general, asset prices, where a lot of them were kind of on autopilot, but also just background liquidity effects, kind of trends that were continuing from one quarter to another without major like rapid changes. Whereas now, in the first half of this year, we're already looking at obviously policy shakeups, but then also we could have liquidity pivots and things like that later this year as well. So I think that there's a number of things that kind of represent trend shifts that we're currently going through.
Lynn Alden points out that macroeconomic conditions are changing once more, following a comparatively stable period following the regional banking crisis in early 2023. According to her, several asset classes have been operating on autopilot for the past 2 years, with trends continuing in a linear pattern because of stable liquidity circumstances. However, we are now entering a period of greater uncertainty and volatility due to recent executive orders, policy changes, and altering fiscal objectives. Changes in liquidity and currency strength are two major factors causing this change. According to Alden, investors typically gravitate toward riskier assets like stocks and Bitcoin when liquidity is plentiful and the value of the dollar declines. On the other side, investors gravitate toward defensive assets like gold and bonds when liquidity becomes scarcer or uncertainty increases. As a result, gold has a mixed outlook. It gains from currency devaluation and a declining dollar, but it also acts as a safe haven asset in times of worsening liquidity. According to her, in the upcoming months, we can witness changes in market trends, with possible changes in liquidity policy introducing even more uncertainty. This implies that, in contrast to the last 2 years, price moves across many asset classes, whether they be Bitcoin, stocks, or gold, may become more swift and unpredictable. Investors should therefore be ready for more frequent changes in market trends as the macroeconomic environment continues to change and present both possibilities and threats. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.